Welcome to our joint SAFE Centre for Economic Policy Research webinar on Corona and Risk Sharing, a European Equity Fund. Note that word equity. You're going to hear that again today. My name is Tim Phillips. I'm from the CEPR and I'm going to be your moderator for today. Now, SAFE stands for Sustainable Architecture for Finance in Europe. That's never been a higher priority than it is now. And one of the most urgent problems to solve now, not next quarter, not next year, but now, is to bring funding to firms without increasing their default risk. And our panel today is going to be describing an innovative program of government assistance and taking your questions on it. So who are our panel? So I want you to say hello, panel, when I say hello to you, so people know who you are. So first, alphabetically, there's Arnoud from the University of Amsterdam. Welcome.
Hello.
Good. And Elena Carletti is coming perhaps later. She's obviously people have a lot to do, so she might be joining us later. So that's Elena from Bocconi University. Pieter Krahnen from Goethe University. Jan, you're presenting today, aren't you? Just not yet.
Yeah, I know. Hello.
Yeah. And also his fellow presenter, Loriana Pelizzon, also from Goethe University. You're going to be our first presenter, aren't you, Loriana?
Hello.
Good, good. And finally, by the magic of the internet, all the way from the Stern School at New York University, Marti Subrahmanyam. Marti, hello.
Hello.
Okay, now thank you all of you for joining us, and thank you all of our attendees for joining us as well. I would not be doing my job if I didn't point out that Arnoud, Elena and Jan are all CEPR fellows too, so that's from my side of the house. Part one of our presentation is looking at the background to this proposal. Part two is going to go into more detail about how it's going to be designed. Now, that's all the introduction. We need to get on with our presentations today. And Loriana, you're starting us off, aren't you, about where this policy comes from and why it's needed.
So good afternoon to everybody. I'm very happy that we have this opportunity to present our three policy papers that we produce with SAFE on coronavirus and financial stabilities. And the key idea started from the fact that we are in this terrible, I must say, crisis, not only from the financial or economic point of view, but also from the personal and health point of view. And I think this is something that is extremely important that we stress from the beginning. As I said, we wrote three policy papers that you can easily find on the SAFE webpage. But the one where we are concentrating mostly today is the last one, where we are trying really to provide some suggestion on how to think not only to the issue today, but also to how to address the issue tomorrow. And just to give an idea of from where we start, and what we are observing everybody from the financial markets, this graph is giving to us a clear idea of the path that this crisis had in the last, let's say, 2 months. This is the performance of the stock indices of the 4 countries in Europe. And as you can easily see, the first case that we get in Europe was on the 17th of January. But what mostly affected the stock market was the lockdown in Italy, the first lockdown in Italy on the 21st of February. And what this graph is showing is that pretty much even if the coronavirus in terms of affecting people has been spread in different ways and different times around Europe for different also impact, with a different impact, well, the stock market pretty much reacted at the same time with a similar, pretty much similar size. So clearly this is a shock that affected all the different countries at the same time with no significant differences between North and South in Europe. The health wave that we are observing and getting statistics pretty much every day, and mostly the lockdown had a huge impact on the corporate sector. We know all, the lockdown means that you cannot continue to produce as it was before. And the first need that these companies had was liquidity. The first need of liquidity has been provided in some way at the beginning via banks. They use their credit, the firms pretty much use their credit lines and all the other capacity that they can get in terms of getting funds from banks. But clearly, if this money are not arriving at a reasonable size and credit lines may be, as we are observing, is not enough, this will cause, of course, not just illiquidity problem, but also solvency issues of these companies. That's why there was several intervention measures. First of all, at the European level, the ECB expanded largely the QE program with 870 billions of intervention to give liquidity to the banking sector, to provide then liquidity to the corporate sector. There was also a reduction of macroprudential requirements in order to allow really banks to provide money to these firms, but clearly it is not enough, and fiscal policies are also extremely important, and sovereign intervene in several ways by providing guarantees for the fund that has been provided by banks, and also via giving money directly to firms in order to support the workforce financial, workforce that clearly in this period are not working. But what we are all observing around Europe is that the most important fiscal intervention has been done at the state level, and this graph is exactly showing to us what it has been announced. Numbers are changing quite a lot through time. We are here really referring to what OECD is indicating on the 7th of April. But clearly, this graph is already showing that there is a huge disparity in terms of size, and I must say also in terms of scope of the way in which this money has been provided to the different, let's say, actors of the economics sector, from firms to families and so on, with clearly Germany that is having a lot of fiscal capacity, and clearly it is using the fiscal capacity that they have in order to support firms and families in Germany. But clearly we do have a lot of other countries that unfortunately do not have this fiscal capacity. Starting from Italy, I think that is a good example that I can provide. And clearly the result is that not having this fiscal capacity, it means that you cannot provide this type of support. And if you will provide the same support of Germany, for example, for Italy, I have no difficulties to say that we are solving a problem now, but we will maybe create a significant sovereign crisis later on that will have an impact not only in Italy, but all around Europe. And the second aspect is that all these type of intervention are largely uncoordinated. There is in some case the use of moratorium. In the other case, there is the use of guarantee or other type of measures. But there is one thing that is in common with all these different interventions. They are all based, from the point of view of the financial support to firms, on providing loans to them. So on providing in some way debt to them. And this is clearly creating a lot of implications. The first implication is that debt instrument is clearly creating issue to these firms later on, because this debt has to be paid independently on the performance of these companies. And this can create a lot of problems. That's why we thought that on top of all the measures that has been proposed that are very good, we need to think also to some equity-like instruments that will allow the firms to go out of this crisis with not too much debt. And the second aspect that we are trying really to address with our proposal is that we need to have more coordination at the European level. And this type of coordination has to be also in terms of fiscal measure. That's why we need a sort of, we call it European Pandemic Equity Funds that will provide the funds for the equity-like instruments that we are proposing in this, in the final paper that we published last week. So I try to be very quick and give the key points of why we think that we have something to say, and it is important that something else on top of that, it has been considered.
Loriana, thank you very much, and you were very quick on this one. Just one question on this: is there the legitimacy, the democratic legitimacy, to get involved in this type of policy at a European level?
If I'm using the hat as a taxpayer of Germany, I can easily tell you, in Germany, we are paying taxes, we are getting very good, fiscal capacity, and now we are using because we need it. The other countries that didn't do this in this way, well, they should not ask to Germany to provide them help, but they need to think that maybe they didn't behave properly in the past. However, I'm using another hat, not just the one as a taxpayer of Germany, that is the one of being a European that did the PhD thanks to a Marie Curie fellowship. And also from the economic point of view, I want to stress that if one country will survive very well out of this crisis in Europe, this will create in any case a significant problem also to that countries, because if not all Europe will go out in a proper way, we will have a lot of problems, starting from the euro currency, that maybe we cannot get it anymore, because if you're creating too much disparities among the different countries, there is no reason to have still the single currency, and also to have maybe, let's say, a European Union. So I think that we need to think now. It's true that we need to act now quickly, but we need to think to the consequences of how we are acting now when we are going out of the crisis.
We'll hear what Jan has to say about the meat and potatoes of the policy, and then there's going to be a lot to discuss after that, I know. So Jan, please tell us about how you see this policy working.
Yeah, thank you, Tim. So I will continue basically and take, this time I will not use slides all the time so that people can see me a bit, and look back at what we have been doing in this paper, but also in the other papers that we have been mentioning in the beginning. We try first to understand what type of crisis are we facing. And there are clear, strong differences to what we had seen in 2008, for instance, where the crisis was really starting in the banking sector and then rolling down to the real sector, so to speak, to the companies and so forth. But now, this time, the problem really starts on the health side. It moves on to the corporate sector, and from there it might move on into the banking sector, and eventually it will arrive at the state level, at the government debt level. So that's the dynamics of the crisis that we see unfold. And we in some paper, we speak of a financial crisis in slow motion. So you can almost anticipate what are the next steps, because there is a logic to it. And part of the logic is that you see at the corporate level, earnings are basically stopped, are stalling for a while, for the duration of that lockdown, for instance, and the standstill of machines and equipment and all that. And that has, of course, big cost to these firms. So how can they continue operating? And we need to find mechanisms to bridge finance that huge gap in economic activity, which is mirrored in a gap in financial flows. Now that's the whole philosophy. And of course, everybody works on that. And almost instinctively, governments around the world use debt as their preferred means of treatment. Right? It's like a doctor who says, this is a vaccine I have been used in other times, I use it. And so it's been done here. And I think it's good that it happens, because it shows that the society or the governments have understood how serious the problem is at the corporate level. And we see all these programs here, as Loriana showed. But most of them, as she said, are on the debt side. And that means that while we speak, the leverage in the corporate sector and each individual company starts to rise. It's like a tide that is eventually dangerous for the entire corporate sector. And not only for the corporate sector, the rising leverage will be mirrored reflected in the balance sheet of the banks, in the P&L of the banks. So they will also have to suffer from the rising default probabilities, default risk that goes hand in hand with it. And that's the reason why we think you should find a way that deals with this build-up of risk at the corporate sector without denying liquidity and financial flows to the firm. So how can you do that? How can you give money to the firm without asking for a repayment at a later stage that is reflected as an additional piece of leverage in their balance sheet? So that's our key question. And the second question that goes very closely with it is that, and that comes from the graph that Loriana showed, where we saw the huge differences in the size of rescue programs. We started the crisis, let's say in January of this year, where the competitive differences across Europe were already quite strong. So Italy, for instance, struggling to keep their growth projections somehow in line with that of other countries in the north of Europe. So that's produced like a gap already that existed in the Eurozone or in the EU at large before the crisis started. Now, through the crisis, with so differently sized rescue programs, that gap is very likely increasing, maybe increasing quite a bit, and making the whole process after the crisis way more unstable. And that is the second aspect. And of course, if these are the two big issues that we see, and that is coming out of our, let's say, analysis of the situation, then we need an instrument or a policy that can rescue both these and repair, if you wish, both these deficiencies. We call this a mitigation strategy with two elements. One is use another financial contract, not debt that is piling up at the corporate level, but use equity. Equity would allow a completely different cash flow stream, which actually strengthens the company in the beginning. And of course, it's not for free. Also, equity has to be repaid in a certain way, but never paid out of the company again. It's just dividends, it's just profits, it's just returns in good times that have to be returned. Of course, a lot of returns in good times, so to make up for the missed returns in bad times. That's the model of risk sharing that goes along with equity. And the second thing is, if we don't want programs to mirror the fiscal capacity of different countries, so weak countries have small programs and strong countries have large programs, then we need, of course, to have somehow an asymmetric rescue program allocated into throughout Europe. So that's the idea. And to put this all together, Loriana mentioned already the European Pandemic Equity Fund. That's a nice word for the time being. We have to fill it with some content, but the idea is allow one portfolio to exist that holds participations or shares or residual claims on basically the entire corporate sector in Europe, with an opportunity of payback in good times by successful companies, while the money given to weaker companies will be lost eventually. And that payback is collected in one fund, which is this European Pandemic Equity Fund. And on the other side of the balance sheet, that's where the funding is, we see again European governments. Maybe not clear to what extent the shares of funding comes in different sizes, but everybody should participate in this. That's our general idea. It would, in our opinion, completely change the character of rescue programs. Rescue programs, rather than being, so to speak, hard-nosed payback expectations, having hard-nosed payback expectations, would really be a partner of the industry that's developing. And to look a bit at how you can do it, we think it is important to distinguish large firms from small firms. Large firms, that are the typical firms we usually talk about when we read textbooks in financial economics at the university, if we read newspaper reports about the US or even Europe's industry. It's mostly about large firms Many of them listed firms, so they have stocks and shares outstanding that are traded on the exchange. And if the company is of that sort, how can I inject equity in such a firm is pretty straightforward. They have already tradable equity instruments outstanding, so we can just add some of these instruments to them. There are certain types of stocks, preferred stocks, that you could imagine being used to bring money in the form of equity into a large listed company. And that has happened in other crises repeatedly. Usually the government who provides that money becomes a co-owner, a shareholder of that company, and may or may not exert certain voting rights and so forth. So that is, in a sense, a tested model that has been used in the past, often not very much to the liking of other shareholders, because suddenly somebody sits there with his own ideas and so forth. But it works, and it can be done fairly easily. If we look at smaller companies, mid-sized or small, typically under the abbreviation SME, small and medium-sized enterprises, it's much more difficult. Before I talk about this, I want to share the information with you without many slides, just say in numbers. That part of the economy that is run by SMEs is by far the most important part. So here you can see how in different countries in Europe, the size of the SME sector is always way beyond half of whatever it is, value added, number of employees, let alone number of companies, right? So SMEs is really the biggest part, the most important part of the economy in all European countries. That may be different in some other countries, may be different in the US, but here in Europe, we should focus a lot of attention on these companies. Now, the problem with SMEs with respect to equity financing is that it is very difficult to reach them. Many SMEs, particularly those, the hidden champions we say in Germany, mid-sized family-owned companies that are really not small workshops, but really global companies with thousands of people working for them, very innovative, etc., often industry leader in their very fields. These companies hate outside ownership. So if you come with a big program saying, well, here's some equity for you, why don't you let me in? I'm the government, your friend, then maybe most of these companies will not do it and will not be happy about it. Apart from this, there are also a lot of legal concerns about giving ownership titles in companies which are not corporations in a sense of a listed company. For that reason, people have shied away of using equity for many, many years. And our, I think, innovative idea that we are trying to present here is that we can actually do something on the financial side, which is looking like equity. So we call it an equity-like instrument, but effectively it's not equity. It only replicates the cash flow that goes along with equity. So this picture shows you, let's say, sketches what the idea is. The idea is, look at the top of the panel, of the page, you see the European Pandemic Equity Fund. That's where the money sits. And the money flows basically on the right side of the graph, on the right flow, on the right pipe, if you wish, as cash immediately to the company, to the SME that you see on the bottom. So the company receives cash now. And in return for receiving cash now, the company accepts the obligation of a later, let's say years, maybe years later, of a temporary higher tax rate on corporate profits that it has to pay. So we basically exchange cash today for excess tax or surcharge tax tomorrow. And this, I give you something now and you give me something if profits are positive. This is exactly what equity is all about. That's the payment structure of equity. Of course, with our scheme, which is only equity type or equity-like and not equity in a legal sense, you have no voting rights. You have no seat on a supervisory board or anything like that. And that's exactly what family businesses and other small up all the way down to a sole proprietor will like. They don't want somebody sitting next to them. And actually, for so many small companies, whoever should do this governance work? Very unrealistic. But our suggestion, which is a truly financial instrument, solves this. Of course, there are many issues that are only highlighted on this slide, which have to be considered. That is, how can you channel the money to firms? What type of institutions exist? And you can talk about that. We think that maybe development banks that exist in most countries, or even the fiscal administration that exists in all countries, might be useful in doing this. You may ask, who provides the quality checks? We don't want to have a program that adds to zombify European industry, to pay out money to companies that would fail anyway. So there must be quality checks. And the only thing we can say now, maybe we leave that for the discussion also, is we are convinced that this works and that there are other examples and programs where you can see that it does work, right? So that is feasible. On the other side, on the left side of the slide, you see, of course, how are these payments collected? That is via the fiscal authorities. That's our idea. So there must be some agreement that fiscal authorities collect money from profitable firms in excess of what they are due anyway to the state and channel that back to the European Pandemic Fund. So that is, in a nutshell, our program. Of course, you have to think about how the whole thing is funded. And we think this is a very important topic. As we speak in Europe, in Brussels, people fight about Corona bonds and so forth, which is one suggestion how one could fund such a thing. We think there can be even other and more clever suggestions, but we don't speak about this now. We will address this topic after Easter. Let me close with just one word on if this fund at a sufficiently large scale would materialize, we see important implications for the European Monetary Union, even for the European Union at large, depending a little bit how you tailor the whole thing. First of all, we truly materialize, we truly create risk sharing across countries through this instrument, because the money of this joint fund will be allocated to different countries according to need, which is a very important criterion, and not according to what was paid in the fund in the first place. And second, we also introduce something completely new in this context, which is reward sharing. So the fund will be successful if the European economy re-emerges from the ashes, so to speak, that it at the moment seems to walk into. And this re-emergence will be seen as a benefit for all of Europe who has helped to put up the money in that fund. So I think that's, in a nutshell, what we try to do. And for my part, I look forward to the questions. I give it back to Tim.
Thank you very much, Jan. Well, there are some questions, which is good, and they do seem to focus a little bit on the conditionality. Who gets this? Who deserves to be funded? I suppose. Kartik Anand was asking about whether there was a role for insisting on some kind of debt restructuring, first of all, which of course we tried 10, 12 years ago. And then following debt restructuring, then this would come into this. We could maybe use this. Michael Wellenbeck's asking, is there not the danger that we are going to be propping up far too many failing businesses? Every day in Europe, there are thousands of businesses that fail, and they fail economically for a good reason. And are we not then going to hobble the recovery, make the recovery less effective by just having too many businesses that aren't sustainable?
Well, let me give two parts as an answer. First part, I mean, if this is true, if this were true, it's also true for all the lending programs we are currently undertaking, right? All the programs, the rescue programs we see nowadays, basically throw loans to firms in the hope that they can survive the crisis. But how do they distinguish between good and bad firms? Well, that's now the sophisticated part, and we would, of course, argue that we can do the same with equity instruments, because it's more the instrument that differs, not the process by which you select good from not so good firms. And I can just refer to yesterday's emergency lending program that has been announced in Germany by the German government, which is a quick loan program which you could get within days. And the process builds on the risk assessment, on the quality assessment by the house banks in the country. Right? It's 100% risk takeover by government, but the risk assessment comes decentrally by those financiers that have a long-standing relationship with the firm. This is, and there are other ways to assess quality, but that is one. And the idea is, and this is the way the German program has been formulated yesterday, the company must have earned a profit last year before the crisis started, so by the end of 2019, or it must have had a profit on average, over the past 3 years. If you don't pass this litmus test of quality, then you're out for the program, right? So I just add that through this program, you create even a wedge between profitable and unprofitable firms in the crisis. And I think this is even a stimulus to exactly that type of renovation, innovation that the person who asked the question was probably hinting at.
Marti, I see you asking to speak there.
Thank you, Tim, and good afternoon, everyone. I'd like to add to what my colleague Jan just said. One important part of the architecture that we are proposing is there is a role for the local banks and development financial institutions that are already well equipped to apply their own credit criteria. Now, these are not infallible. There may be some mistakes made, but I would also point out, just as the criteria that Jan briefly outlined will screen out the real outliers, the ones that have no chance of success, I think we should not forget that we will have some winners. There are some genuinely stressed companies whose business models are fundamentally sound, but unfortunately have been hobbled by all the problems that we face today. So I would not be too pessimistic. Yes, is it possible that some of the company in the portfolio will fail? Yes. But is it also possible that some of them will be huge successes? Yes. So we are not hoping for huge rewards alone, but we are hoping for a share of the future prosperity of Europe.
Now, there are two questions that I want to put to the panel, and if I were to summarize them, they both perhaps are hinting that maybe you're being a little bit naive here. Nora suggesting that would not SMEs who could receive the handout game the system by playing around with their accounts? We know that this has happened in the past from large corporations. Why should SMEs be any different? And therefore, that's surely going to affect the returns that you're going to get on this fund. Ettore says, how would this work? How would the tax surcharge work in countries that have high tax evasion? And so there is a wide range of tax evasion within Europe, and so therefore that could then create a different set of returns in different countries. Who would like to take that?
I'll give it a shot.
Yeah, and then I'm going to go to Arnoud. Yeah, okay.
Yeah, there is a problem of tax evasion or avoidance, even more mildly. But I think in Europe, there is a very well-run value-added tax system. There are leakages there, but by and large, it is well enforced. So what we are proposing is not necessarily through the income tax system, which may be subject to evasion, but the value-added tax system, which is largely enforced, and I think there are fewer leakages. So of course, the details have to be worked out, but I think that the chance of leakage can be minimized.
Arnoud, what do you think about this?
From a country where tax evasion is somewhat less of a problem, the Netherlands, we seem to be somewhat tougher. But I see all kinds of mechanisms that particularly our approach opens up. Because the support that you give with this equity instrument will depend on the behavior of the firms in the past. It will depend on how they made profits in the past, whether they paid taxes in the past. So actually the mechanism itself will weed out the companies that are prudent and paying taxes from the companies that have been operating in the gray zone.
Now, there's also a question here from Christian, who's saying that the downside risk of equity financing is that the risk is much larger than debt financing. Do we think that governments and the taxpayers, more important, the voters, are willing to take that risk if they see the size of the program that you want to put in place? Do you think that governments and taxpayers are going to be happy about taking this sort of risk in taking equity stakes in literally hundreds of thousands of small companies?
Yeah, so let me compare that to the alternative. The alternative is that we have large transfers of debt instruments across borders. What this instrument does, it is basically puts rather the negative view of transfers, meaning loans, and try to get, in the words of Pieter, Krahnen, hard-nosed to get the money back, to get it into an optimistic mode, and that is that we share in the success. So yes, there is risk, but the risk with debt transfers, I can tell you, is there clearly as well. But the upside provides for the much more optimistic view, potential optimistic view, that we share in the success of Europe. And if I, as a politician, would have to explain to my voters, I would have a much easier time explaining that we are sharing in the future profits than we are trying to get our money back in the future.
It's also interesting with respect to have this risk taken by basically everybody who invests into the fund from an incentive point of view. So if we really make an investment where we benefit only if the economy will succeed, it's a lot like a macroeconomic risk factor in principle, then it changes the incentives in the European setting also a bit. Not all the rescue money will be equity, so I may now overemphasize the point, but from this instrument alone, there is a very mutual interest in mutual success because we all benefit from it. And another small remark, risk sharing for the state, the risk that they take with being a partner in the firm in good times is something that they are very much used to, because the whole corporate income tax is exactly that model. It's just the same. It's a copycat, so to speak.
Marti.
Yes, I would say there are two aspects to this, and it's been hinted at by my colleagues, Arnoud and Jan. The first is purely economic. Yes, there are problems in terms of implementation, but as Arnoud suggested, these are not very different from the problems for the implementation of the debt programs. But the important element that distinguishes equity from debt is the risk sharing. In this case, a pan-European risk sharing. The second part of my answer would be, we're not talking only about an economic objective. We're talking about ultimately a political and social objective. That is to create a common identity for Europe. So without that commonality of purpose, I think the European dream cannot live. And I think that is the moment we are living in today. So these smaller details about the individual interests of particular countries has to give room to this commonality of purpose.
Loriana, you want to say something?
Coming, of course, from Italy, where this issue of collecting taxes, I think, is very, let's say, relevant. I think I should say something. And also something that is happening in this period already on the measure that the government has started to implement. That clearly people that were not paying taxes, they're already now not receiving the type of support that the other are receiving. And I think that this is already a good, let's say, lesson that finally, even in Italy, we are giving that on one side, if you pay taxes, you will have help from the government. So the government will be not just there just to try to collect the money from you, but is also helping you in the bad state of the world. So it's going to change the mentality of the people and also the approach and the relationship that we are having with the state, but I think also with Europe, if this will be done at the European level. Because of course, all these small and medium enterprise, they have to remember that when they have having problem, someone helped them. So clearly, this is not an economic argument, but since we are talking about a political argument as well, we can really try to enforce this a little bit more. But at the end, I think that people has to agree on this situation that you are receiving and you have to give. Otherwise, we will never end. And the same issue it will be with the money that you are giving with debt.
Now, you mentioned political argument, and something's come up here. There's a great question coming in here that the fund's going to end up investing in competing companies, and especially for larger companies that exist in one country but trade around Europe. And so isn't this going to cause a conflict within Europe as governments invest in their own winners from the same fund?
Yeah, let me take it first, and then Marti will add to it.
Yes.
Keep in mind, we have the proposal is a common fund. And indeed, there will be execution involved at the local level in order to weed out the good firms from the firms that don't deserve. But by creating this mechanism, the national governments have an interest via the fund in how firms in other countries are doing. So we are really creating a mechanism actually where the national champions become less important rather than more important. And the second element of the question is, keep in mind, we recognize in this proposal that smaller firms, the SMEs that Jan was referring to, are in the end, it's the dynamic engine of Europe. And the bigger companies are always supported by the national governments, by their politicians. The main focus here is even on the SMEs, and the SMEs do not have this political backing and the distortions that come with it that the big companies have. So in that sense, we only are part of the solution. I don't think we can make matters worse.
Marti.
Yes, I agree with what Arnoud just said, but I would also add that this is not a problem peculiar to the instance we are talking about. If you look at the United States, for example, the large asset management companies like a Vanguard or a BlackRock or a Fidelity, they invest in large portfolios. Today, the market is moving more and more to passive funds, which consist of trillions of dollars under management, each fund. So we are talking about really a situation where there is no alternative but to invest in literally thousands of companies. And of course, in the US context, they're relatively larger companies. But there, if you look at their portfolios, of course, they have competing companies. Of course, they invest in Microsoft, and they also invest in Amazon. They also invest in Apple. So there are lots of areas where all these companies compete. And that's fine. That's just fine. In fact, it makes for really better corporate governance because BlackRock, as we speak, is telling company A, look, your corporate governance practices are not as good as B. And that power for the common equity fund will create, I would say, in the ultimate analysis, better corporate governance.
You mentioned BlackRock, and Michael Wellenbeck he's asked a question that also mentions BlackRock. These investors are already active in the market. They are continuing to be invest, albeit probably at a reduced level in the near future and maybe the medium term as well. Are you then not going to be investing in the companies that have been discarded by the market?
Well, there is some risk that there will be some lemons in the portfolio. We cannot avoid that. But I think we'll also be able to see some new emerging gems that are basically startups, which have a huge future. One of the things, as someone who lives in the United States, I observe the startup culture in Europe is not anywhere as active as in the United States. And I think this could be a great opportunity to fund ideas that are great ideas, but the market as a whole is not willing to take them. And this fund can afford to take that risk. There will be losers, but there'll be a few huge winners.
Now, there is a question for Nora again. It's another one. Why is this better than helicopter money?
I mean, very clearly, our suggestion is not throwing around money randomly at everybody who can move. It is a very selective process. It is basically replicating the decision that would be taken if you would extend the classical loan program, lending program, but it comes in a different format. And the small differences between debt and equity, which may for an outsider be almost irrelevant because it's both finance, it's both money, has huge impact on the build-up of future risks that we try to explain. And that's our main focus. Right? So we, also in addition to what Arnoud said, what Marti said, we are not talking about a venture capital innovation fund, but we are talking about a rescue fund, how to do a rescue fund in these moments. The best way that the future becomes bright, also for the participating institutions. And helicopter money would basically be almost the opposite project. It had no repayment scheme, and it doesn't distinguish between good and bad firms, but we have both.
The only thing that I want to add is exactly this, that helicopter money will go also, there will be a significant probability that will go to people that do not really need it too much. So that's why even if the size can be very similar in terms of the intervention between helicopter money and the different measure, including the one that we are proposing, we are sure, or at least we try, to be sure that the money are really going to whom that need this money. That's exactly the difference between helicopter money and this type of proposals that we that it has been also proposed for loans, but clearly we are proposing for the.
I would like to underscore two additional aspects of our proposal. The first is that this will be conditional on the firm's past behavior. If the firm has been earning profits and paying taxes, etc., they will be qualified. Second, we have an important element in our proposal, that is the local financial institutions, the banks and development financial institutions, who are already qualified to weed out the good from the bad. So they will be important players. That it is not just at the European level alone, it's also at the national level. So of course there will be mistakes made, but I think there is hope that they will be able to pick up some of the winners and try to avoid some of the real lemons.
So Loriana said it's only for firms who need it. Right? And I wanted to explain why this is actually very true, because for everybody accepting that cash inflow, there is a price tag. And the price tag is that tax increase that they have to accept for a number of years. The longer these number of years where there is this tax surcharge to be paid, the more difficult it will become to game the system. That's still answering to a question that you posed in the very beginning and I forgot to answer. Right? So gaming is definitely a problem, but you can deal with it. And the state does it in many respects when it thinks about its corporate tax. But here, by having several years where you have to pay a higher tax, the very, very good companies who know they are winners will not ask for that money because they have to pay in expected value a very high payback price, that this increased tax on a very high profit that they expect to make, so they reject it. And it's really the firms that are weaker that will ask for the money, and that's why the only ceiling or the only floor that we have to introduce is the low quality. We have to check that it's not too low the quality, and that's why all the other criteria matter that everybody was talking about.
Yeah, you know, going back to the criteria, clearly, I don't know if it is again because, you know, we need to think to people that maybe want just to twist the system and try to get opportunities. So for example, you know, if I'm a bank that I know that one of my clients need money, well, I will just lie and say he's a good guy and so I will have back my money. So this can be also one of the problems. We were also discussing about this. The fact is that now in Europe, we have something that is called banking union. And we have the SSM that at least via different, let's say, approaches is going to certify that bank A or bank B is using a certain criteria to evaluate let's say, the goodness of the firms. So clearly, this one is having some issue, but in any case, it will be at the European level that we have the certification that banks are going to evaluate in a more or less a similar way across the different countries, the different borrowers. So we do have, in some sense, a sort of guarantee that the criteria will be, of course, different among countries and so on. But there is something that is putting everything at the same level. At least we benefit for the huge work that we have done so far with SSM.
There are a couple of questions talking about sustainability. Should we make sustainable business models part of the conditionality for investing? And also Victoria's asking, are we not in some ways discriminating against social entrepreneurship where there is not so much profitability to pay back, and so therefore they won't be as attractive for lending?
Let me take the issue of the sustainability. I think this is an important point. And the reason why it's an important point is because, of course, we have been saying before that the initial eligibility criteria should be, for example, the profitability in the last year or in the last 3 years. But of course, it does not guarantee that the firm will remain profitable and will be viable, in particular, given the virus. I mean, it can be operating in sectors that will be mostly affected, and even very good pre-virus firms may not survive in those sectors. Or it could simply be a firm that even if operating in a sector that will survive, the firm itself won't survive. So the sustainability is important, but I think there we have to do for a narrow approach, in the sense that it will be impossible to do a proper sustainability analysis of all the companies. So I join my colleagues before in saying that there will be some firms that will not make it, for sure. But nevertheless, I think the initial criteria should be probably the most important role. And of course, we can also rely on banks helping also for the sustainability analysis, but this is a time-consuming activity for banks. So even there may be some aspect that will not be fully covered in my view.
I thought maybe that the question was also looking at the ESG type of criteria. So not only sustainability of the life of the firm, but whether they do good things in society or
yes.
so forth. So I think, frankly, this program is not designed for that purpose, right? So there are different purposes at different times, and this is really a rescue program that will be, in a certain sense, rough and imprecise to some extent, but fast, and it has predictable consequences on the default development of these firms that are being aided. Right? And I think that's, of course, we can now add other programs on top. Why don't you have also green finance a bit more than brown and all that? But this will make the process, I think, in the end, way more ineffective, given the problem we are currently facing.
Christian has got an interesting question here. It's always interesting doing webinars with economists in the audience, because he said, since each country's share in the fund will be small, does this not create a free rider problem, that countries with a small share in the fund have an incentive to rely on the others to make the fund work, because it's good for them to invest as widely as possible if they are in charge of their own conditionality? Who wants to take that one?
A good question, of course. Yes. So who is funding it? That's in the end. So we said we don't have an answer yet, but it's absolutely not carved in any stone that the funding and the spending shares in this portfolio are equal to in any sense. Right? It could well be that you have countries who have a lot of money to spend still, and others who are in big need, and that are different countries, of course. And so why not have the transfer organized that way? This is not a free lunch, I have to say, because the program is, if you calibrate the different parameters somewhat rightly, then there is a clearly expected payback for the money you give out. Right? So if you put in more money, you are in a certain sense a larger shareholder in Europe's prosperity.
The question is really appropriate in that there may be some gamesmanship by individual countries. But I would also say the commonality of purpose, the public good aspect of it. The fact is, if you actually sully the pond in which we all fish, it will ultimately hurt you. So there is that. Although you may benefit more than me, in the end, if we do damage to the pond, we will all be hurt. So I'm hoping that public good aspect of it will actually keep these disincentives in check.
Yeah, let me add one thing, because one thing has been underemphasized. We are talking about a fund, an equity fund, that needs to be professionally managed. Mm-hmm. It's not that the governments are going to be in charge on a daily basis. There is a professional management. There will be professional criteria, and those criteria will involve many of the things that have been mentioned. So the whole free rider idea means that you bring it too close to the political process. And you have to have professional management. And the way we will think about this also in our future policy briefs is to see what the role can be of the European Investment Bank, role of others can be in guaranteeing this professional attitude that we need in this fund. If we don't have it, the fund will work against the fund. It will create frictions between the countries. So we have to set it up in the right way.
Now, there is a question here about, this is a little bit more detailed, about what is the quantitative correspondence between the amount that you pay to firms and the amount that you take back in tax. Have we any ideas about how that would work? Arnoud, you're nodding.
Yeah, let me take the first stab at it. Pieter has the other part of the answer. First, it's an equity fund. So it means these are not just transfers. So these are investments that have a return, and the return flows back to the fund. So the concern about investments being made all in one country has to have much less of a bite than it normally would have, because the returns are going back to the fund. This is not a free handover of cash. The other half of the answer, Jan, I think you had some ideas about differences in keys between the funding and the use of the funds. Maybe you want to add to that.
Yes, I do. And I add some other point, that is, we have a number of parameters in this model that we didn't specify, and that needs a bit of simulation and so forth. But it's really, how long will the extra tax have to be paid? Is it 5 years or 10 years or 15 years? What is the extent of this extra surcharge? Is it 1%, 5%, 10% of corporate tax? And if you play around with these numbers, given a certain amount of cash that you inject, you can get different expected returns for your investment. And of course, that is a work that we cannot do in such a little policy paper. It's a larger effort, but we imagine that this should be somehow standardized across Europe, so that we in the end get a good average return and make the whole fund feasible. Now, on the funding side, to Arnoud's point, we could imagine that we have a very different, let's say, country allocation in the use of fund as opposed to the raising of funds, right? And that could be part of that European project. Well, I think our preliminary discussions are not pointing in a new Eurobond, but in something more, in a different model. But the idea will be, in the end, money is put up by governments, and maybe those that can afford it could put up more, and countries who are more in need will get more. So there is this transfer element, but it is over time. It's not a transfer. Over time, there is a fair return to be calculated in.
We haven't said yet how much money this is going to take, how big this fund is going to be. Does anyone want to put a figure on this? We're talking enormous numbers about everything at the moment. So I'd like to hear your enormous number.
Who raises that?
Actually, we are having a lot of discussions on this very point, and there are still things to be sorted out. But I would say at a very minimum, we're talking about hundreds of billions of euros. Okay, that's the order of magnitude. I don't want to put a specific number on it, because we have to do a lot of calculation as to what is the extent of the problem, and somebody's got to make an educated guess as to how long this crisis is going to last. None of us knows really how long it will last. Unless you have firm sort of grip on that, frankly, these are all numbers we are all plucking from the air.
Yeah, Tim, you can build this up over time. We don't know these things in advance, so you start with a fund of substantial size, and then you indeed have to think about the initial fund has to have 50 billion at least to start. But this 50 billion can be built up over time, can become more over time. So I wouldn't immediately discourage people looking at ideas that it involves a lot of money, because every European plan involves a lot of money. But keep in mind, this plan is aimed at the future. It is equity. It's about creating a dynamic Europe. It is creating returns. So we are really talking about investors that should be willing, public and maybe also private, to put money into this plan.
Yeah, I would like to add to this last sentence of Arnoud, maybe even private money can be interested. We shouldn't expect, if we can establish such a program, it opens an area, a segment of the economy for public and private investment, which hitherto has never been accessible. So you can invest and diversify as much as you want in a mutual fund. You can never get to small and medium-sized industry. They are out of the picture. It's completely European families' wealth that's been managed and growing and so forth. But this fund would offer an opportunity to add this to our global portfolio. It has high diversification value, I would guess. And that would add the value also for outsiders to think about it. It all depends in the end on the calibration of tax rate, duration, and initial cash inflow. And then we have to see, right? Who is willing to accept it and who is willing to give it at the assumed or the known quality level of that firm.
We're getting near the end, so I have to ask a big question now. And it's sort of hanging around in the background of this. And Reina's asked it, isn't a fiscal union a prerequisite for running this kind of fund?
So, Tim, shall I start answering this, and then the Netherlands, so then maybe my Italian counterparts can take can follow me. Then we also clearly have the European political scene at the table. This equity fund is not a transfer union. So this is about the internal market, I would say. This is about creating a strong economic base in Europe. So if we need anything, and particularly this country, let me just look at the self-interest of the Netherlands. The Netherlands has a fully interest in the internal market. Our economy is a full export-import economy. And it depends crucially on how Europe develops, in what way we can compete across the world. Because other regions in the world, the US and China, are very strong have a very strong trading power. We as Europe have to come together and build this as well. And my country has an interest in that, therefore has an interest in the viability of businesses in Italy.
Now, for Southern Europe, who's going to take the Southern European angle on this?
Yeah, I think that, clearly we are not touching this very delicate political issue. And it will be not really, the purpose is not to create a fiscal European environment, but pretty much it is let's say a good financial project that is based on, the classical principle of capital invested and remuneration. So I don't see anything related. The only thing that is related to fiscal is the capacity to tax some of these companies. So in some sense, we are using one channel, but because it is the easiest one to reach the small and medium enterprise, but it's not really a fiscal program for Europe. That's not really our idea.
Elena, Loriana invited you to comment. Would you have something to say about this?
Yes. No, I fully agree with both what Loriana and Aaron just said. So first, it should be in the interest of all countries, not just of the stronger of the weaker, because as he said, the stronger also suffer if the weaker countries are not successful, and vice versa. And I also agree with Loriana, this is not about a fiscal union. It has nothing to do with it. It is simply pulling together of resources in the way we have seen already in other institutions, in other European institutions, without this being a fiscal union.
Now we're very close to the end now. So Jan, I have to come back to you. And this comes to a question also from Alison Schultz as well, who's interested in the idea. But she's asking, are you pushing this idea in policy circles? What comes next, Jan?
Well, we are pushing as much as we can, but we are unfortunately only academics, no official office. So our main way of pushing is to influence the mood, the willingness to think in a new way about how finance in a crisis can be managed. And although the issue seems to be little, I mean, a very technical thing, equity or debt, who cares? I think the effect is enormous. That's what we predict. And by the way, by establishing such a fund with this common interest in the recovery, in the prosperity of Europe, we don't create a fiscal union, but we may create an interest in a fiscal union because we share the benefits of that in this program. So pushing is something we, of course, we try to infiltrate, so to speak, thought circles in governments to the best of our ability. We are coming a bit late to the party, I have to say, because the ideas should have been around earlier, but this is how ideas come up, only under pressure, right? So diamonds are produced under pressure, and maybe that's the right moment, nevertheless.
And within SAFE, how are you going to develop this now?
Well, within SAFE, as we are all part of that pandemic policy team, we will continue working over the Easter days, and we will think there is a very important element missing in this whole story, that is the funding side. We now know, basically as we speak, how in Europe they fight about Corona bonds, Euro bonds and all that, and we hope that we can, for at least in the confines of that institution, offer a better and easier and more acceptable way to find a common project. I think it is important that we understand the interests of, let's say, to make things more easy, the southern and the northern view, that there are real political and important interests behind that, which we should respect, and we must come up with a solution which is neither a Eurobond nor a complete separate national problem. And that's what we try to do. And I think it's feasible by working a bit more on our instrument. And if this would be a Netflix series, I would say that was the next round will give you the...
We're seeing many unlikely things, but I think a Netflix series is somewhat, yeah. Loriana and Elena as well. Elena first and then Loriana, and then we have to close after that.
Yes.
Elena.
No, I just wanted to add to what Jan just said, that even within current initiatives, one could think of building up this equity fund, meaning under the current discussions of providing additional funds, for example, to the EIB, to the European Investment Bank, one could think of trying to push the use of these funds towards an equity instrument rather than just, again, loans. So it's not that we are necessarily speaking about an additional discussion on finding additional funds, but even within those that should be available, and I understand that there is already an agreement on these funds to the EIB as of today, there could just be a different use.
Loriana, finally.
Yeah, well, the suggestion is that clearly we are discussing a lot among each other, as you can realize, but we will be also happy if any of the, let's say, participants to this meeting today, if they have suggestions, we are very happy to listen to their suggestions. So they just need to write to us, and we will be very happy, you know, to consider ideas, because what we really need now is ideas, and try to move on. That's the idea.
Yes, and that there are also a lot of open comments as well that we haven't had time to get to, but we really are out of time now. So thank you to everybody that did provide those, and you'll be able to take those into account as well. That is all we have time for, as I say. If you want to read more about this proposal, it is SAFE Policy Letter number 81, as you saw at the beginning of the presentation. It was also published on Vox.eu on the 3rd of April, the title Coronavirus and Financial Stability 3.0, Tri-Equity, Risk Sharing for Companies, Large and Small, which pretty well explains it. Note also, while I'm mentioning Vox.eu, all our panelists have also been regular contributors and references for the CEPR's COVID-19 coverage on issues like this. So search on their names at voxeu.org for more background reading on that. Now, thank you to the panel. You've done a great job. if you could all wave goodbye now, because our time is over. Thank you very much. That's perfect. And thank you to our audience for spending time with us today. So many of you stayed right to the end. And I think that shows what a good discussion it was and what an interesting proposal it is. So to all of you, stay safe. We will see you again soon. And from SAFE and the CEPR, goodbye.